There's a number flashing on my screen lately, and honestly, it's been making it very hard to sleep. Silver is trading at $86.62 an ounce. Just let that sink in for a moment. This is a new all-time high. I'm not talking about a technical high adjusted for inflation or some cherry-picked chart from the 1970s. This is a level that silver has never ever reached in modern market history. But what is even more important than the price itself is the structure, that S holding it all up. And if you understand how futures exchanges work, how the clearing systems function, and how regulators behave when real stress shows up in the plumbing of the financial system, one thing becomes crystal clear. We are quietly, methodically, and almost completely unnoticed by the mainstream, drifting toward in one of the most dangerous moments the precious metals market has faced since 1980. Let's rewind just 3 weeks. The CME Group, the exchange that trades silver futures, pulled a very familiar lever. They raised the margin requirements on silver futures contracts. They didn't do it just once or even twice. They raised margins 3 times in less than a month. That right there tells you that this market is not behaving normally. Exchanges do not take that kind of action unless volatility is accelerating and the risk managers behind the scenes are starting to sweat big time. Today is Sunday, January 12th, 2026, and I want to walk you through exactly what the playbook looks like if silver pushes beyond that critical $95 mark. This isn't about predicting tomorrow's price. This is about understanding what happens when a system like this gets pushed into a corner. I'm going to explain how the exchange rules actually work, what historical precedent tells us, and why, this time, even a trading halt might not be enough to solve the underlying problem. So how did we get here? For months, the physical silver market has been tightening. We've seen reports of industrial demand surging, not just from the usual suspects like solar panels and electric vehicles, but from new technology sectors as well. At the same time, we're seeing supply disruptions from major mining regions, everything from labor strikes to geopolitical tensions. This has created a perfect storm where the demand for physical metal is starting to overwhelm the available supply. But the futures market, the world of paper silver, has been slow to react. That is, until now. The big players, the commercial banks and hedge funds have been holding massive short positions. They've been betting that the price of silver will go down. And for a long time, they were right. They were able to suppress the price by creating more and more paper contracts. But now, that game is starting to fall apart. The price is rising, and for every dollar it goes up, their losses mount exponentially. This is where the margin calls come in. When you trade futures, you don't pay the full price of the contract. You put up a small amount of money called margin, which is like a good faith deposit. If the price moves against you, the exchange will issue a margin call, demanding that you deposit more money to cover your potential losses. By raising the margin requirements 3 times, the CME is essentially telling the shorts, your risk is getting too big. You need to put up more cash right now. This is designed to force them to close their positions, which means they have to buy back the silver contracts they sold. Of course, this buying pressure only pushes the price even higher, creating a vicious cycle, what we call a short squeeze. We saw a glimpse of this in 2021 with the Wall Street silver movement, but that was just a warm-up. The forces at play today are much, much larger. Now, let's talk about what happens if silver breaks $95. At that point, we're in uncharted territory. The first thing you can expect is another, much more aggressive series of margin hikes. The CME might even move to what's called liquidation-only trading. This is a drastic step where they prohibit anyone from opening new long positions. You can only sell what you already have. This is a tactic they used back in 1980 during the Hunt brothers' attempt to corner the silver market. It's a move designed to kill the rally and protect the exchange itself from going bankrupt. The problem is, it also destroys market confidence. It's the exchange basically admitting that they've lost control. And in today's interconnected financial world, the fallout from that would be immense. It wouldn't just be silver traders who get hurt. The shockwaves would ripple through the entire financial system. And this is the key point I want to make. This time, even a trading halt or a liquidation-only order might not work. Why? Because the underlying problem isn't just speculative fever, it's a genuine physical shortage. Unlike in 1980, there's a massive global community of investors who understand the difference between paper silver and physical silver. If the CME tries to shut down the paper market, it will likely trigger a mad dash for the real thing. People will demand delivery of physical metal, and there simply won't be enough to go around. The price on the futures exchange could be frozen at, say, $100, but the price for a real ounce of silver in your hand could be $200, $300, or even higher. The paper market would become irrelevant. We would see the final and complete price decoupling of paper and physical metal. This isn't just a theory. It is the inevitable endgame when a paper derivative market loses its connection to the underlying physical asset. We are closer to that moment than we have ever been. Keep watching these margin requirements, because they are the canary in the coal mine. Thanks for watching, and be sure to subscribe for more updates as the situation unfolds. Hey everyone, and welcome back to the channel. Today, we're diving deep into a fascinating and potentially explosive situation developing in the silver market. It's a story about paper versus physical, east versus west, and what happens when these powerful forces start pulling in opposite directions. You see, unlike a stock that trades on one exchange, silver is a global game. It's priced and traded around the clock in major hubs like New York, London, Shanghai, and on over-the-counter markets worldwide. For the most part, these markets move in lockstep, with prices staying very close to each other. But right now, something unusual is happening. The markets are diverging and the gap is getting wider. Let's break down what's going on. The price of physical silver in Shanghai is currently trading several dollars higher than the futures price in New York. We're not talking about a few cents here. This is a significant premium, far larger than anything we've seen historically. So what does this tell us? In simple terms, it screams that there's a serious squeeze on physical silver available in Asia, coupled with incredibly strong demand. Buyers in the East are willing to pay a hefty premium to get their hands on actual physical metal right now. This isn't just a number on a screen. It reflects a real-world scramble for a tangible asset. Now, whenever you see a price difference like this between two markets for the same thing, a word should pop into your head: arbitrage. Arbitrage is the lifeblood of efficient markets. It is the practice of buying an asset in a lower-priced market and simultaneously selling it in a higher-priced one to pocket the difference. In this case, it means big, professional players can theoretically buy silver contracts in New York, take delivery of the physical bars, and ship them to Shanghai to sell for a much higher price. This process is what normally keeps global prices aligned, but here's where it gets really interesting. This arbitrage activity creates a powerful natural price floor for silver in the Western markets. Think about it. If the New York price tries to fall any further, it just makes that arbitrage opportunity even more profitable. More and more buyers will step in, not to speculate on the price going up, but to simply buy the cheap physical metal and move it to where it's valued more highly. As long as that juicy premium exists in Shanghai, the paper price in New York can't just collapse. Any significant dip will be met with a wave of physical buying, effectively putting a brake on the decline. And we don't have to guess if this is happening. The evidence is right there in the data. We can see this dynamic playing out in real time if we look at the COMEX warehouse reports. COMEX is the primary futures exchange for metals in the US. They have two categories of silver in their vaults: eligible and registered. Registered silver is the key one to watch. It's the metal that is fully available for immediate delivery to anyone who wants to cash in their futures contract for physical bars. And what has been happening to those registered inventories? They've been dropping, and dropping fast. The pace of withdrawals has been accelerating, which is a clear sign that market participants are taking physical delivery and moving the metal out of the system. Now, some people might point to the eligible inventories and say, look, there's still plenty of silver. And it's true, the amount of eligible silver is substantial. But here's the crucial difference. Eligible silver is just silver that meets the exchange standards and is sitting in the vault. It is not for sale. The owners of that silver have not made it available for delivery. To become available, the owner has to voluntarily register it. And in a market where physical silver is tight and fetching a premium elsewhere, why would they be in a hurry to do that? They're more likely to hold onto their physical metal or sell it directly into the higher-priced physical market, bypassing the paper exchange altogether. This reluctance to register metal highlights a fundamental weakness in the paper markets. This brings us to the core of the issue. The exchanges, like COMEX, are brilliant at managing the financial side of things. They can set contract specifications, adjust margin requirements, and manage the settlement process. They are masters of the paper game. But there was one thing they absolutely cannot do. They cannot create physical silver out of thin air. When real-world physical demand starts to overwhelm the supply available within the paper contract system, control begins to shift. The power moves away from the financial mechanisms and back to the owners of the actual physical metal. The paper tail can no longer wag the physical dog. So what happens next? What if this trend continues? Imagine a scenario where the drain on registered inventories continues to accelerate. The exchange might try to intervene, perhaps by raising margins to make it more expensive to hold a contract, or even by temporarily halting trading. But even if they shut down the New York futures market, it won't stop the rest of the world. Price discovery for physical silver will simply continue in London, Shanghai, and everywhere else people are buying and selling actual bars and coins. The global market doesn't stop just because one venue closes its doors. And when that trading eventually resumes, the paper price in New York will face a moment of truth. It will have to realign with the physical reality of the global market. If it doesn't, if it opens at a price that is still artificially low compared to the rest of the world, the drain on its inventories will become a flood. The remaining registered silver would be snapped up in an instant, leading to a potential default scenario where the exchange can no longer deliver the physical metal it has promised. This is the ultimate risk of a disconnect between paper and physical prices. In conclusion, the widening spread between Shanghai and New York isn't just a quirky market anomaly, it's a signal of profound stress in the physical silver market. It has created a strong price floor, fueled a drain on exchange inventories, and exposed the inherent limitations of a paper-based pricing system when physical demand asserts itself. The world is watching to see how this tug-of-war plays out. Will the paper markets be able to regain control, or will the physical market finally force a major price realignment? The coming weeks and months could be some of the most pivotal in the history of the silver market. Thanks so much for watching. This is a complex topic, so I'd love to hear your thoughts in the comments below. What do you make of this price divergence? Be sure to like this video if you found it valuable, and subscribe to the channel for more deep dives into the markets. I'll see you in the next one. Hey everyone, and welcome back to the channel. Today, we're diving deep into a market that's showing some serious signs of strain: silver. We're not just talking about price charts today. We're looking at the fundamental mechanics, the nuts and bolts of what's really driving this market. The pressures we're seeing aren't just random noise or market sentiment. They're rooted in a genuine structural deficit, and that's a game changer. For years, global silver production has been struggling to keep up with skyrocketing demand. Think about it. Our world is becoming more and more electrified. Industrial consumption of silver is on a tear. Thanks to solar panels, electric vehicles, all our electronics, medical devices, and massive infrastructure projects. Every one of these sectors needs silver, and their demand is growing relentlessly. But that's only one side of the equation. On the other side, we have investment demand. With inflation concerns, currency risks, and geopolitical instability around the globe, more and more investors are turning to silver as a safe haven, a way to protect their wealth. So you have this perfect storm. Industrial demand is soaring, and investment demand is surging right alongside it. So how has the market been balancing this so far? Well, for a while, recycling and drawing down existing inventories have helped bridge the supply gap. But here's the critical point. These are finite resources. You can only recycle so much, and you can only draw down inventories until they're gone. These are temporary fixes, not long-term solutions. And what about new supply? Can't we just mine more? It's not that simple. Bringing a new mine online isn't a matter of months. It takes years, sometimes even a decade of farming, of planning, permits, and construction. So the supply side of the silver market is incredibly inelastic. It can't respond quickly to sudden spikes in demand. This isn't some speculative bubble driven purely by hype. What we're witnessing is the inevitable collision of multiple powerful demand streams with a supply system that is fundamentally constrained. It's a classic case of too much demand chasing too little supply. Now, let's talk about something you might be hearing about: exchange interventions. Things like margin hikes, trading halts, or other emergency measures. When you see these happen, it's easy to think, oh, the authorities are stepping in to cool things down, the rally must be over. But you need to view these actions through the correct lens. Historically, when exchanges intervene in this way, it's not because they're trying to reverse the fundamental trend. It's an act of self-preservation. It's an admission that physical demand is starting to overpower the paper-based trading mechanisms. They are trying to contain risk, not invalidate the underlying reality. In many ways, these interventions are a confirmation that the physical market is under immense pressure. They signal that the trend is real, not that it's ending. Understanding this distinction is crucial, especially when you consider how you're exposed to the silver market. The implications of this volatility are very different depending on what you hold. If you own physical silver, coins, bars, the actual metal, you are largely insulated from the drama on the exchanges. Your ownership isn't affected by trading halts or rule changes. You hold the asset directly. On the other hand, if your exposure is through leveraged paper positions, like futures contracts, you are much more vulnerable. Margin increases can lead to margin calls, forcing you to either put up more capital or liquidate your position, often at an unfavorable time. Liquidity can dry up, making it hard to get in or out of a trade. This is where the risk lies in periods of high volatility. The difference between holding the physical asset and a paper claim on it becomes incredibly important during times of market stress. So where does that leave us? Silver is at a truly pivotal juncture. Let's recap the verifiable data points we're seeing. We're approaching all-time highs in price. The physical supply is tightening, and we can see that in the data. Inventories are being drawn down at an accelerating rate. We're seeing rising premiums for physical silver around the world, which means people are willing to pay more than the spot price to get their hands on the actual metal. And we're seeing repeated margin increases on the exchanges. When you put all these pieces together, they paint a clear picture of a market under significant and growing structural strain. Of course, this doesn't mean the price will only go up in a straight line. We should absolutely expect volatility. There will be sharp pullbacks and periods of consolidation. That's just the nature of markets, especially one under this much tension. However, the broader underlying trend will likely remain intact until the fundamental problem is solved, until that deep imbalance between supply and demand is resolved. And as we've discussed, that's not something that can happen overnight. So the key takeaway here is to look beyond just the daily price fluctuations. To really understand what's happening, you need to understand the mechanics of the market. Markets move based on incentives, constraints, and physical realities. And right now, all of those forces in the silver market are pointing in the same direction. The gears are in motion, and it's a fascinating and critical time for anyone interested in this space. Don't just watch the price, watch the fundamentals. Watch the inventory levels, watch the premiums, and watch the actions of the exchanges. That's where the real story is being told. Thanks for watching, everyone. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the markets. We'll see you in the next video.